You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, every time I feel like I finally got a handle on where this industry is heading, feels like the whole landscape just shifts again, like massively.
Really moving incredibly fast.
Yeah. We talk about speed, but right now, the digital asset space, it's not just accelerating. It feels like it's rebuilding its own foundations. Policy, companies, the actual tech, it's all happening at once.
It is. It's almost too much to track.
Exactly. Which is why we rely on the material you send in, to help us focus on what really matters, cut through the day-to-day churn.
And that's crucial. Filtering is key. Based on the intelligence you've pulled together, the big picture, the structural change we really need to dig into today is this convergence.
Convergence. Okay.
Yeah, you're seeing crypto infrastructure borrowing ideas from traditional finance, things like proper institutional issuance, ways to handle fraud.
Right.
While at the exact same time, TradFi is scrambling, realizing they absolutely need blockchain's core features, mostly atomic settlement. They're definitely meeting in the middle.
Okay. That intersection point, that's where the interesting stuff always happens, isn't it? That deep analysis is kind of what we love doing here on Vocal Technologist. So, let's start right at the top then, government level stuff.
Makes sense.
Because it's not just tech folks eyeing Bitcoin now. Lawmakers are looking at it like a strategic national asset. We got to talk about the Bitcoin Act.
It's a huge conceptual leap, really. You've got people like Representative Nick Begich, Senator Cynthia Lummis pushing legislation to formally call Bitcoin a strategic reserve asset for the U.S.
Yeah, and they're not messing around with the numbers either. The bill actually directs the U.S. government to acquire, 1 million BTC?
A million BTC over 5 years.
Wow.
And here's the really interesting part, politically speaking. It has to be budget neutral. That's the claim.
How do they even manage that?
Well, the argument hinges on this idea that the U.S. balance sheet is way too dependent on gold. They're saying adding Bitcoin is just smart diversification, good for the country's long-term economic health.
Correct.
Basically, framing Bitcoin as a national security issue.
Which is miles away from the usual digital gold for individuals narrative.
Okay, so while the government's thinking macro, corporations are consolidating, right? Specifically these digital asset treasury companies, the DADs.
Exactly. That consolidation really kicked off with Strive buying Semler Scientific. That was kind of the first big date merger we've seen.
And that deal sort of signaled a shift in how we value these companies.
Definitely. It's less about traditional earnings now. The metric everyone's suddenly focused on is Bitcoin per share.
Sounds nice and simple, doesn't it? How much Bitcoin sits behind my share. But I think one of the reports you flagged was pretty skeptical about the standard metric they use for that.
Oh, absolutely. We need a bit of caution here. NYDIG put out some research, and they were really critical of the common metric, mNAV market value to net asset value. They basically called it misleading.
Misleading how? What's it missing?
Well, the issue is that these date companies, they aren't just sitting on a pile of Bitcoin. Most of them run actual businesses, operations that add value.
Okay, so mNAV doesn't capture that business value. Right. And even more importantly, it often fails to properly account for complex liabilities. Think convertible debt. If the market price of Bitcoin tanks, those debt holders, they don't want stock. They want their cash back. mNAV doesn't really model that risk well, potentially painting a much rosier picture than reality. Yeah. You can't just look at the assets. You got to look hard at the liabilities, too.
So even in crypto, good old-fashioned financial statement analysis is still king. Makes sense. All right, speaking of things that absolutely depend on clean backing, that brings us neatly to stablecoins. The complexity there is just skyrocketing alongside the market size.
Oh, the market size potential is enormous. Citi just updated their 2030 forecast for stablecoins. They're now looking at a base case of, get us, $1.9 trillion.
$1.9 trillion, seriously?
Seriously, with a bull case heading towards maybe $4 trillion. I mean, $1.9 trillion, just for perspective, that's nearly the size of Australia's entire stock market today.
That is staggering. What's driving that kind of projection, especially given all the regulatory headaches stablecoins used to face?
It's clarity, mostly. We're finally seeing real movement on the regulatory front. Specifically, the Genius Act.
Right. Heard about that.
It aims to set federal standards for payment stablecoins. Things like demanding strict one-to-one backing with safe, liquid assets, no weird stuff in the reserves, and really robust compliance procedures.
And a key piece, didn't the Genius Act also say issuers can't just pay simple interest to people for holding the stablecoin? That seems aimed right at Tether and Circle hoarding all that treasury yield.
Exactly. Historically, they kept all the interest earned from the reserves backing the tokens. That proposed rule cracks the door open for new models. And that's why you're seeing the rise of these yield-sharing stablecoins like Athena's USD or M0 Agora.
Competing by giving yield back.
Precisely. But Tether has a strong counterargument. They say, look, for millions of users, especially in emerging markets with high inflation, USDT isn't some investment product they expect yield from.
It's just a digital dollar.
It's a digital dollar substitute. Stability is the feature, not earning 4% interest. Utility versus investment, basically.
Makes sense. But the really big philosophical fight brewing in stablecoins now, it has to be about immutability, right? Circle exploring ways to reverse USDC transactions.
That's the absolute core tension between the crypto purist view and what's needed for mass adoption. Immutability transactions are final, forever, no censorship. That's foundational.
Yeah.
But, if your life savings get hacked and vanish in seconds with zero recourse, mainstream users are just not going to accept that. Trust goes out the window.
Okay, but hold on. If you can reverse transactions, aren't we just rebuilding the old banking system, just with more complicated tech? How's that different from me calling my bank to dispute a fraudulent charge?
Well, the key difference is how it's done. Or how it's proposed anyway. It wouldn't be Circle just deciding to undo something. The idea, and supporters point to examples like what happened on Sui, where validators froze and returned hacked funds. The idea is that the mechanism for reversibility would be built into the code, agreed upon by the network, and only triggered under very specific, extreme, documented conditions, like a major exploit. Not just some arbitrary decision. It's an attempt at an engineered compromise.
An engineered compromise. Okay, that distinction between code-based rules and arbitrary control is crucial. And it's not just the US dollar driving this, right? We're seeing local currency stablecoins pop up too.
Definitely. Base, for example, already hosts like a dozen local stablecoins. They're testing Singapore dollar, Aussie dollar tokens. It's all about unlocking specific local payment cases around the world. Tokenization isn't just a dollar game anymore.
And that whole explosion in payment utility, that leads us right into the infrastructure fight, where the big traditional finance players, they're not just watching anymore, are they? They're actively building.
They're jumping in. Look at that Chainlink and Swift pilot with UBS Tokenize.
Right, using Swift messages.
Exactly. Using the same Swift messages every bank already knows how to use, but hooking them up to smart contracts to handle tokenized fund subscriptions and redemptions. It plugs tokenization right into the existing, $100 trillion fund industry without making them rip everything out.
It's like an adapter, a gateway.
Pretty much. And then you have Visa looking right at the settlement layer. They're actively testing stablecoin payments, USDC, EURC for cross-border stuff. The goal, cut settlement from days down to minutes.
Days to minutes? That's huge.
It shows they see stablecoins as real competition for slow systems like ACH or Swift, not just some niche crypto thing.
And all this institutional interest, it creates a need for an easy button for issuing this stuff compliantly, which is where Stripe and Bridge come in with Open Issuance.
Yeah, that's standardization taken to the next level. It lets basically any business create their own custom stablecoins that are designed to be Genius Act ready from day one. Handle the compliance, the reporting, all the tricky stuff.
And they're using partners like BlackRock and Fidelity for the actual reserve management.
Right, for trust and transparency. The days of wondering what's really backing a stablecoin seem to be ending, which is good.
Okay, now let's swing back to Ethereum itself, because all this activity, all this efficiency being built on layer 2s, it's great for users, cheaper fees and all that, but it does create a kind of structural tension, doesn't it?
It absolutely does.
Yeah.
L2 solutions, look at Aerodrome on Base. It generated something like over $250 million in chain GDP last year.
Chain GDP, so the value moving through it?
Essentially, yeah. The volume of value being transferred and used on that L2. It's outpacing some of the old guard protocols like Uniswap or Eliv in terms of activity.
And that's because L2 fees are so much lower.
Massively lower, especially after EIP 4844, that recent Ethereum upgrade people sometimes call proto-dank sharding. It made storing L2 data on the main chain way, way cheaper.
So if the L2s are capturing all the user activity and, frankly, the fee revenue, what's left as Ethereum's core indispensable value? Why stick with the main chain?
It really comes down to the ideology, credible neutrality.
Credible neutrality, explain that.
L2s give you speed and low cost. But sometimes, maybe, there are slight centralization risks. Who controls the sequencer? Who pushes upgrades? Ethereum L1, the main chain, is meant to be the ultimate guarantee. The promise that the code runs as written, that your property rights are respected, absolutely no censorship, no matter who you are or where you are.
So Ethereum is prioritizing that absolute neutrality, that finality, even if it means being less efficient economically in the short term.
That's the trade-off. If this whole system is about building global programmable trust, then that neutrality, that guarantee, becomes the single most valuable thing it offers. It's the foundation.
Right. And that concept, that's what people mean by trustware.
Exactly. If Ethereum L1 provides that credible neutrality, then everything built on top, whether it's a stablecoin, a DeFi protocol, or prediction market, it can inherit that same finality, that same neutrality. You don't need to trust the person on the other side of the transaction. You just need to trust the code running on that neutral base layer, programmable trust primitives.
Okay, trustware. That actually leads us perfectly into the last area we need to cover, the state of speculation in crypto. Because there's this weird, almost nihilistic feeling around right now, isn't there? Even with overall prices relatively high. Why do people feel like the fun's gone out of, say, meme markets?
Well, structurally, it often boils down to pretty simple economics.
Yeah.
Bad tokenomics and just high friction.
Meaning?
High trading fees, maybe 1%, sometimes up to 3% on some platforms. That just slowly bleeds speculators dry unless there's a constant fire hose of new money coming in. And on top of that, a lot of new projects just have awful token designs.
Like what?
Things like massively inflated, fully diluted valuations, or FDVs, low initial floats creating artificial scarcity, the low float, high FDVs trap, and then you see huge chunks, like over 60% sometimes, allocated to insiders and early investors with really weak lockup periods.
So it feels like it's designed for insiders to dump on retail investors who arrive later.
It often looks that way, yeah. And that's why the market structure itself seems to be shifting. We're moving into what some analysts are calling the revenue meta.
The revenue meta.
The idea is that those purely speculative premiums are shrinking. Wealth is rotating towards projects that actually generate real value, real revenue. Prices are getting pushed down towards some kind of fundamental floor, much like in traditional finance where revenue is, the baseline for a sustainable valuation.
We are seeing some crazy operational efficiency in crypto that supports that fundamental value, right?
Absolutely astonishing efficiency. You look at companies like Tether or platforms like Hyperliquid. They're hitting metrics like over $100 million in revenue per employee.
Per employee? That's insane.
It's that kind of efficiency that lets them be profitable even when the pure speculative frenzy cools off.
And that efficiency, does it also enable maybe cleaner forms of speculation?
I think so. Look at prediction markets. Platforms like Melee Markets introducing things called viral markets. They let creators basically monetize their influence by posing questions, and speculators get a shot at asymmetric upside. It's like crowdsourcing truth or cultural consensus without the usual gatekeepers. Maybe prediction markets are where the smarter speculative energy goes next, moving away from just pure meme coins.
Wow. Okay, so we've gone from Congress thinking about Bitcoin like it's gold all the way through global standards for potentially trillions in stablecoins and ended up at programmable trust built on incredibly efficient new rails. It's quite a journey.
The big takeaway really is just the speed of adoption, isn't it? The whole financial system seems to be hurtling towards atomic settlement using these new tools. But those core tensions, they're still right there.
Yeah.
How do you balance that core crypto value of immutability with the need for consumer protection, for real-world trust? And how do you make sure all the efficiency gains on layer 2 don't accidentally undermine the neutrality of the base layer, the L1?
And that brings us right back to trustware. That promise of code is law, guaranteed transactions. But here's the thought, the question maybe to leave everyone with this week. If the foundations, the rails for this new programmable layer, this trustware, if they aren't built on truly credibly neutral, decentralized structures right from the start, if they end up being, half decentralized or heavily influenced by corporate control or shifting policies, does this whole tech revolution lead us to global fairness? Or could it accidentally pave the way for something much darker, like permanent surveillance or programmable coercion?
That is definitely something to think about. A crucial question as this all unfolds. We'll have to pick this up again next time with the next batch of material you send over.
Spoken Tech for your ears.